Thanks, John. So the paper is costly short selling and stock price announcements, stock price reactions to earnings announcements. The overall outline, what I'll do today is I'll talk about the literature and I'll talk about hypothesis development, sort of the, maybe in a sense that's sort of the key thinking behind this paper is how this data fits the literature and how this data fits the models about short selling. I'm going to talk a little bit more. Scott did some of this morning, and in fact we'll have a similar set of pictures today talking about the equity lending market and the data used in this experiment in sort of more detail, and maybe get into some of the questions that were sort of brought up early on today. And then we'll talk about the results. The main idea of the results is that when short selling is costly, it may be sort of a rare event, and we'll see how rare it is here in a minute. But when it is costly, it means a lot for future returns. It means a lot for the distribution of announcement day returns. One thing that also happens is that trading volume is reduced significantly when short selling is difficult. And one thing that happens, it sort of doesn't fit into a rational expectations model, but if you think about post-earnings announcement drift, there's sort of a strong connection between post-earnings announcement drift and short selling constraints. Let's start with a literature review. Some early work is asking a basic question. Seneca in that paper is asking, is short selling a positive signal or a negative signal? It could be a negative signal if you think short sellers aren't very well informed. It could be a negative signal if you think, if you think short sellers are well informed. It could also be a negative signal because short sellers are actually selling and thereby pushing down prices. But it could be a positive signal because short sellers eventually have to cover. And since they have this built-in demand that comes in the future, it could prop up prices at that point. Miller thinks about sort of a different question about short selling. He says, well, what happens if short selling is restricted or constrained? And sort of this has come up a few times today, but the Miller story basically says if there's a divergence of opinion and there's a short sale constraint, then prices will be biased upwards. And Figluski is one of the first empirical papers to look at short interest and look at how future returns respond to that short interest. I'm going to break up the literature into sort of two main camps here, although they're not mutually exclusive. I'm going to break the world into the Miller and Hong and Stein camp, where prices can be biased. And the idea there is if we have a divergence of opinion in the short sale constraint, then the optimists will be kept out of the market, and the optimists will be left in the market, and the pessimists will be kept out of the market, and the prices will rise. There's a lot of empirical support for this idea. This list is not inclusive of all of the papers that could be interpreted as positive support of the Miller story. There's sort of another camp, you could call it the rational camp, the Diamond and Verrecchia model, that says if everyone's rational, there's no reason to see a price bias. We will see effects, but we won't see a price bias. People will get the prices right on average. There's some empirical evidence that sort of indirectly could be interpreted as supporting this idea. Charles, in his paper in 2003, look at authorization requirements and find that when authorization requirements become more difficult, bid-ask spreads increase. We'll talk a minute about how that could be mapped into the Diamond and Verrecchia thinking. Ferry, Christoph, and Angel show there's no abnormal correlation between short selling and price decline. So if you're thinking about sort of a Miller-style world, this experiment is looking at the NASDAQ national market for a subset where the bid test does not apply. In that subset, it should be the case that in that subset, there should be some correlation between that bid test and the restriction and prices. And they find no such correlation. And Sharon Rook and Duke find that short selling improves aggregate market quality in 11 countries. There are a couple of papers that are direct evidence supporting Diamond and Verrecchia. Jennings and Starks, in their 86 paper, look at the speed of adjustment to earnings announcements. And what they find is that speed of adjustment is higher when stocks have options available. Skinner does a very similar thing, but on this, he has a regression where he's looking at stock price reactions. On the right-hand side, he's looking at information or unexpected earnings. And he finds that for option firms, the reactions are lessened than for non-option firms. And so the idea of both those papers is options is a proxy for ability to short sell. And so their idea is basically that if you can't short sell, you can go to the options market. We have a paper that actually looks at the connection between options and short selling costs, and we find that linkage is not as simple as it seems. One problem with these papers, and authors are the first to admit this problem, is that the choice to list options on a particular firm is not an exogenous choice. It tends to be large firms. It tends to be highly volatile firms that have options available. So short-selling data and short-selling restrictions could be better proxied with something else, presumably. So the Diamond-Verrecchia model, to think a little bit more carefully about it, it is a rational expectations model with no price bias built in. But the Diamond-Verrecchia model does have some features that respond to short sale constraints. In particular, volume will decrease when short selling is constrained. Prices will take longer to adjust to private information when short selling is constrained. And prices will take a particularly long time to adjust to private information when that private information is negative. So if you took this world where prices are adjusting to private information and sort of shocked that world by releasing all the private information and making it public, what you would see is large price reactions for constrained stocks and relatively small price reactions for unconstrained stocks. So I'll give sort of a diagram of the way I think of the experiment I'm about to run. True firm value can be either high or low, and stocks are going to be constantly adjusting to their true value. For unconstrained stocks, that adjustment process will be relatively fast in both directions. But when short sales constraints bind, that adjustment process is going to be relatively slow. It's going to be particularly slow if there's negative information and the short sale constraints bind. The experiment I'm going to think about is I'm actually going to think about shocking the system with information, and the information I'm going to use is an earnings announcement. Shocking the system with information and comparing the earnings announcement day returns. In particular, I'll be comparing sort of the blue arrows with the red arrows. And the idea is we should see the distribution of all the blue arrows is more compact than the distribution of all the red arrows. That's sort of our first main hypothesis. We should also see a left skewness in the distribution of red arrows, or a more refined way to think about it, we should see more left skewness in the red distribution than in the blue distribution. And the reason is that especially slow adjustment on the downside. Let me talk about the data I'm going to use to run this experiment. The data I'm going to use to run, yeah, Charles.
Can you go back to that? Can you give me the intuition for why the adjustment would be slow upward in the presence of short sales?
Well, there's fewer.
Repeat the question.
Yeah. So why is the upward adjustment slow and the downward adjustment slow? In particular, why is the upward adjustment slow in the presence of short sale constraints? There's just simply less trades when there's short sale constraints, according to this model. Some of those trades, all trades, buys and sells, are informative, and since some of the trades are informative trades and they're removed, these are noise traders trying to make basically non-information-driven trades. Those trades are removed, so prices are adjusting more slowly because there's more periods of no trade, basically, in those markets. Okay, so this is the diagram, and this is actually a very similar diagram to one Scott put forward earlier on. We can think of a short seller as a borrower in our context. The short seller needs to borrow shares. The short seller doesn't own the shares. The short seller needs to borrow shares, and just like sort of Scott said, the short seller is going to provide collateral to some sort of securities lender. There's lots of players that are securities lenders. The ones we're going to care about are custodian lenders. They tend to be sort of the largest lenders, and that's where the data we have come from. In exchange for the collateral, the securities lender is going to provide shares to the borrower. That collateral is going to earn interest. The interest is returned in part to the borrower through a rebate rate. And here's where sort of my experiment differs from a lot of the experiments that we've seen earlier on. So I'm going to focus in on that rebate rate and sort of determine when that rebate rate is important for prices. It turns out that the rebate rate is almost always pretty high. In other words, it's almost always pretty cheap to borrow shares. But every once in a while, the rebate rate gets low. In other words, it gets expensive to borrow shares. So in general, in the equity lending market, there are lots of loans. We saw a lot today about that. And most of the loans are cheap. But a few loans are costly, and these are what's called the stock specials. The data set I have is provided by one of the largest equity lenders. It's a one-year period, mostly 1999. Most of the loans are short-term, we'll see here in a minute. And there are a lot of loans, 273,000 loans on a cross-section of around 5,000 or 6,000 different stocks. A few papers have talked about this market, sort of focused on this market explicitly. DeVolio, Duffy, Garligno, and Peterson, and a paper including myself, have looked at this market sort of in their main focus. I'll talk a little bit about the data I'm going to use here for a minute or two. This goes back to a lot of the discussion that's gone on today. How long do these short positions stay out? Now, I don't have short volume. What I have is loan volume, and I have sort of markings of loan. But these loans are very, very short term. The median loan length in this database is just 3 days. The mode is 1 day. For the purposes of sort of the discussions we've had today, I can't really tell if the short positions are lasting longer than 1 day. They could easily be lasting longer than 1 day. But what I can tell is that the rates I have in my database, the rebate rates, are generally updated very quickly. They're generally sort of refreshed all the time. They're sort of short-term pricing that works pretty well. So I've also got some loans that last a long time, for the full year. Loan values, these loans are generally maybe larger than you'd think. There's a fair number at 10 million or more. The bump you see there is just because there's sort of a discount for loans that are for over $1 million. Here's a key variable for the rest of sort of my talk, and it's specialness. Specialness is just the difference between the general collateral rate and the rebate rate on any particular loan. The way to think about specialness is the opportunity cost to borrow any particular stock, with the benchmark being borrowing the general collateral stock. And if these words don't mean that much to you, the general collateral rate is just the Fed funds rate minus some relatively small haircut, 15 or 20 basis points. And it's sort of exactly what Scott was talking about. Thinking about this distribution a bit, we can see that a lot of stocks are very easy to borrow in the sense that their specialness is very close to zero. That sort of fits our intuition about this market. However, stocks can get very expensive to borrow. I've actually cut off this graph. The most expensive to borrow stock is 77%. So we have one stock that actually costs 77% of its value per year to borrow. Presumably that's worth borrowing. And this is basically a variable that has sort of an infinite range that way, if you want to think about it that way. But this variable doesn't have any obvious cutoffs to determine if you want to select two groups, what's hard to borrow and what's easy to borrow. There's no obvious way to sort of to make the distinction. So we're going to use a few distinctions here. We're going to think about a 25 basis point cutoff, and that came from our discussions with this particular equity lender. 25 basis points is what they think of as a special rate. We're also going to use 100 basis points, or 1%, because that sort of fits what they think of as the number of stocks that are on special every day, empirically. Whenever we can, we'll use this variable in its continuous form. What does the database cover in terms of CRISP? Well, if you think of the CRISP deciles, the largest stocks have a lot of coverage. What you see are CRISP deciles sort of in the total size of the bar. The black part is whether a stock showed up at least once in that decile. And for large stocks, there's very good coverage. For mid-cap stocks, it starts to decrease. And for small caps, the coverage is pretty low. Although, I also have data from several sources sort of in this world. And one of the sources I have is data from a specific small stock lender. And the coverage here is actually better than the coverage from a specific small stock lender. Just this, another way to say it is this lender has a lot of the market sort of across the entire range. One thing that sort of surprised us when we looked at that is that it's not the case that that mid-cap and small-cap are not lent out here. They are lent out here quite frequently. Sort of the big question I think a lot of people probably have is, where do the specials lie in this distribution? And the specials lie in this distribution not exclusively in the mid-cap, but sort of concentrated in mid-cap. If we think about looking at the percentage of the database for the large quintile of stocks, the percentage of the database that's on special is about 3% for the large quintile. 97% of those stocks aren't on special. If we do the same thing for the next quintile, it's 7% and 92, 10% and 90%, 8% and 91, 5% and 95. So the point here is that maybe this is more evenly distributed than your priors. It's pretty evenly distributed compared with our priors, at least. Yeah, good question. This is the 100 basis points cutoff for specialness, and we see a similar pattern with different cutoffs. And the point, sort of important point, I think, in my mind, is that it's not the case that all small cap and mid cap stocks are on special, and it's also not the case that all large cap stocks are never on special. In fact, there are a significant number of large cap stocks that do go on special. There is a relationship, of course, but it's not a lockstep relationship. A number of specials per day, this might be interesting. 156 stocks are on special a day on average in our database, which amounts to about 5% of the loans, 5 or 6%. So let's think about the main experiment I sort of alluded to. Let's sort of shock the system with information here. I'm just going to collect a distribution of those blue announcement day returns and a distribution of the red announcement day returns. And the blue announcement day returns are going to be the announcement day returns in this column. They're going to be the stocks that are easy to borrow. The red ones are going to be in this column. These are going to be the stocks that are hard to borrow. We've got a bunch of panels here that are all saying about the same thing. All the different panels correspond to different measures of specialness, and we'll sort of just focus on one and then talk about the results sort of in the broad picture. The first result to point out is in this orange oval here, and the result says that the standard deviation of those announcement day returns is larger when stocks are hard to borrow, and it's smaller when stocks aren't hard to borrow. Skewness, we can look at skewness, and what's interesting to find here is that skewness is pretty large and positive for the sample of stocks that are easy to borrow, and it's less positive for stocks that are hard to borrow. In other words, there's more left skewness in the distribution of announcement day returns when stocks are hard to borrow, and that sort of fits the model very well. Another measure of spread is this average absolute value. Average absolute value shows the same thing, 7% for stocks that are hard to borrow and 5% for stocks that aren't hard to borrow. These results, the green and sort of the red oval, are consistent through all the definitions. And let's talk about the definitions for a second. Here's just a 25 basis point cutoff. Here's 100 basis points cutoff. And that's based on specialness on the announcement day. So if we think back to the theory, though, maybe it's not specialness on the announcement day that matters the most. Maybe it's specialness right before the announcement that matters the most. That's when the private information is trying to get into prices. So we take a cutoff that's a 5-day range before the announcement, 25 basis point cutoff for the average of specialness over that period. Also 100 basis points cutoff for the average over that period. Similar results. There's another way to think about specialness, and you might say, well, there might not be any loans every day, so the average might be misleading potentially misleading because of missing data. Why don't we just look for the incidence of any specialness, just counting, and find specialness above 25 basis points and specialness above 100 basis points at least once in that 5-day period before the earnings announcement. Results are also similar there. The mean and the standard deviation results, they sort of depend on which definition we use. The two results to sort of focus on coming through and supporting the Diamond-Varecchio model are the skewness and the average absolute value. Yep. Yeah, that's exactly where I was going, actually. So the idea that we've done here is sort of shocking. I'll repeat the question. I'm going to paraphrase the question. Is there any stock-specific attribute that could be driving this other than specialness? Is that sort of fit? Okay. I will get to that. Let me just rephrase that question. Is there an endogeneity problem? Is it something about the stock that drives specialness? Maybe information itself is driving specialness, and then specialness is driving the announcement return. Could it be that information is driving everything throughout the whole tree, and we're just focusing on the last branch of the tree? That's a possibility. We're actually going to look at an experiment here in a minute that will go some way to alleviate that concern. So this experiment fits the theory pretty well, but it doesn't allow us to do any of the controls that we've been thinking about. Let's do a regression setting where we can think about controls. In this regression, what I have is left-hand side variable is the absolute value of the excess returns on the announcement day, actually on the 2-day period around the announcement. And on the right-hand side, I have a number of controls and specialness. So the purple oval here says that as specialness increases, there's a positive and statistically significant relationship between specialness and absolute returns. In other words, where the specialness is high, announcement day returns are high. Okay, so that's part of the hypothesis. Another way to think about the hypothesis is that this is going to be practically most important when we think about specialness in the case of negative information. So what we have here is specialness times the dummy variable. And sort of, I'm following Scott's footsteps here, although I didn't know I was following Scott's footsteps. But instead of sort of looking at analysts who may have incentive to be consistent as opposed to accurate, what we're going to do is just look at the market. And the market presumably is going to get news right, and they're going to interpret news correctly every time. We're going to say a large market reaction means that there was a lot of news that came out. So the problem is thinking about what the analysts expect, and we're going to avoid that problem. And what we see here is that interaction term actually has a pretty strong statistical significance there and a relatively large coefficient estimate, basically indicating that this effect is strongest when there's negative information coming out, sort of backing up both of the main ideas there. So we have these results sort of fitting the earnings announcement context. Another piece of the Diamond-Verrecchio model would be to think about the mechanism itself. They've thought about a mechanism where volume goes down. Volume actually decreases whenever short selling is constrained. We can go ahead and look at short sale constraints as sort of an event and compare a short sale constraint-driven event with the earnings announcement. Use that new context. Look at sort of microstructure ideas here, and we look at volume, we look at spread, we look at price, we look at depth around the first incidence of specialness. So we find a period of 10 days where there is no specialness, and then a period where specialness spiked up. And what do we find here? That there's a significant result that volume decreases, and that's sort of consistent with the Diamond-Verrecchio. Spread doesn't seem to have much there. Depth doesn't seem to have much change there. And interestingly, prices don't seem to have much change there either. So sort of according to the Miller model, if you had an incidence of a short sale constraint, presuming there's some divergence of opinion on every stock, if there's a short sale constraint, you would expect prices to rise. We don't actually see that here. In fact, the coefficient estimates are negative, but they're not statistically different from zero. But the fact that it's not positive, it's not an experiment I'm running here, but it's evidence that's not at its face consistent with the Miller story. Another sort of way to think about testing a Diamond-Verrecchio model is sort of think about it more generally. We could think about market quality around times of specialness in a more general sense. Let's remove ourselves from the first instance of specialness. Let's remove ourselves from earnings announcements themselves. And instead, let's just look at market quality on a daily basis and determine whether that market quality has anything to do with specialness. So I'm going to use the Hasbrouck decomposition of prices. And the Hasbrouck decomposition takes prices and decomposes it into one permanent component and one transient component. The transient component is thought of as the noise. And sort of one measure of market quality is the variation in that noise. High variation in the noise, low quality, low variation in the noise relative to the signal, high quality. So the sort of the simplest thing to do is take two samples of stocks that are on special that day and stocks that aren't on special that day, compute a ratio of the standard deviation of the pricing error to the total standard deviation, and think about how that ratio differs between the two samples, the special and the non-special sample. What we find is that ratio is 20% for the entire section, the entire cross-section, but for the subsample where stocks are on special, that ratio is 26%. So there's a 6% decrease in market quality using that measure when stocks are on special. Another way to do that is take that measure of market, the inverse measure of market quality, and put it on the left-hand side of a regression where you can control for a number of things and include specialness in that regression. What do we find here? Specialness actually has a strong statistically significant effect. Sort of the economic interpretation here is that for a one standard deviation move in specialness in our database, which is about 87 basis points, what you find is that market quality decreases by about 40%. So it's sort of a substantial change. We can measure specialness with either the continuous variable or an indicator of specialness over 100 basis points. The result seems to stay the same. Got a bunch of control variables that are interesting here and sort of necessary, especially the last two and this one right here. But they don't swamp the effect. The effect sort of survives all of these various controls, including stock-specific fixed effects. One question I think will hopefully be of a lot of interest to people in this audience is what happens after the earnings announcement? And so I'm going to sort of remove myself from Diamond Varecchia. They would want to have nothing to do with what I'm about to say, but if we know there's post-earnings announcement drift, and Diamond Varecchia wouldn't want to have anything to do with post-earnings announcement drift, but if we know that post-earnings announcement drift does exist, can we try to tease out some relationship between specialness and the realization of that drift? And the answer is yes. So sort of the experiment I want to run here is think about post-earnings announcement drift ex post realized. I want to measure the drift in a 2-quarter period and ask how much of that drift or how much of that total return was realized on the first day relative to the entire period. It's sort of a measure of market quality. If markets were functioning very well, we'd expect 100% to be realized on the first day, on the earnings announcement day itself. In other words, there would be no drift at all. And for those stocks with no news, it is around 100%. However, when there's bad news, for the typical stock, the stock that's not hard to borrow, only 67% of the total return is realized on the earnings announcement day. For the stocks that are hard to borrow, that ratio is reduced significantly down to 35%. So one way to sort of think about this is on the earnings announcement day, that sort of closing price reflects final value 32% worse, 32% less accurately when stocks are hard to borrow. So one sort of puzzling thing, and I'm curious to hear what everyone has to say about this, but it's almost symmetric for good news. And sort of thinking about, maybe thinking about specialness as proxying some sort of more generalized market friction would be one way to think about that. Yeah. Okay. Yeah, maybe that's the effect. Maybe it's not a short selling effect, but it's an institution. So the idea here is that there's a relationship between institutional ownership and post-earnings announcement drift, and it may be that the institutional ownership. So sort of the context here is that institutional ownership has been shown to be very highly correlated with the specialness measure that I have here. So it may be that institutional ownership is driving this result as opposed to specialness. So that's a good suggestion and something I should definitely check out. Back to the original question, what if some other factor, what if information, for instance, is driving specialness, and then that specialness, and we're measuring the relationship between specialness and that distributional effect. What if it's the information that's driving everything and not the specialness that's driving everything? Well, that's a potential problem with this paper, and that's why I've done this and actually some other things in the paper to sort of ameliorate that concern. Specialness can be caused by many things. It could be caused by information related to earnings announcements. But we found in the Gakesy, Musto, and Reed paper that merger acquirers have a high tendency to be on special. it may have nothing to do, or we can be reasonably certain that it has no direct correlation to the earnings announcement sort of short-term effect there. Similarly, for seasoned equity offerings, there's Cadillac, Loderer, and Sheehan show this V-shaped pattern. We find that specialness is associated with seasoned equity offerings, presumably to capture some profits during that pattern. Dividend reinvestment discount programs, we also have sort of unpublished work showing that there's a pretty close correlation between these dividend reinvestment discount programs and specialness itself. And finally, IPOs tend to be hard to borrow. For a sample of stocks where these episodic corporate events are going on in the background, we can be reasonably assured that the specialness is being caused by these and not necessarily by the earnings announcement. Let's take a sample. It's a relatively small sample, but 1,600 stocks or so, where 1,600 stocks during this period are subject to one of these conditions. And we can say that if stocks are on special during that period, it's likely not caused by the earnings announcement itself. Do the same sort of theoretical experiment. And the last two results sort of hold. Skewness and average absolute value have the same distributional differences that we saw in the larger sample. In results that I didn't put up here, actually look at sort of regression connection between unexpected earnings, a measure of private information, and specialness. It turns out not to be a big effect on specialness. It does, or it can be shown to be a pretty big effect on short selling itself, but short selling itself may not have enough quantity to drive this price constraint, and that's sort of the issue that we care about the most. So what are the overall results? We find that borrowing constrained stocks adjust more, especially to bad news. Unconstrained stocks, one way to think about this is unconstrained stocks reflect prices much better than constrained stocks. There are large downward adjustments in prices when news is announced. So to think a little bit more broadly about this, if we think about prices reflecting information badly when stocks are hard to borrow, maybe one question from a broader perspective is, well, since we want prices to reflect information as quickly as possible, how can we change this? How can we fix this problem? One solution, and sort of probably the most effective solution, would be to transform the equity lending market. But of course, that would take a lot of work, I guess. These markets, I haven't talked about it much, but these markets are sort of a rare corner of finance where things are still pretty inefficient. It's sort of a phone call-based network to a large extent. Things have changed, but these are pretty inefficient markets. Sort of an easier thing to do from the perspective of, say, a money manager or a mutual fund, especially a large one, would be to have that money manager or mutual fund lend out their shares. If that money manager or mutual fund lent out their shares, there would be a reduction in these problems of informational efficiency, volatility, and left skewness. And that reduction would be focused on exactly the portfolio that manager held. To the extent that problems in the equity lending market are driven by a lack of supply and not these institutional restrictions, that part of the problem can be ameliorated. And there's a surprising amount of reluctance to lend shares, sort of even today. So thanks very much. That's it.
There's a question.
Simon and Varechia model doesn't really think about dispersion of beliefs. And that's sort of why I haven't really run through that. But to the extent that specialness is the best measure of short selling constraints, sort of one nice experiment that would be in a different set of papers, and there's sort of a long line of papers that are looking at very similar questions, asking, is dispersion in beliefs, when you combine that with specialness, what does that do to prices, or how does that affect prices? And that's sort of a different question that I'm asking, but it's a legitimate question. Yeah.
Consider interacting your measure of, say, cost of short selling with other ways you can retain a short, things which people talked about earlier, such as, like, the option markets and so on and so forth.
Yeah, it's a great question, and something I actually wanted to mention that I didn't mention.
Can you repeat it?
The question is, are there other ways to obtain short exposure, and can we interact specialness with these other ways of obtaining short exposure that might affect specialness? And one of the ways of obtaining short exposure that's not borrowing stocks that was brought up is the options market. The options market is clearly a secondary way of getting short exposure, or maybe a primary way for some market participants. And so I've controlled for options here in this regression and in the later regressions. The interaction could be important, and so the thing is, it gets very difficult to think about the connection between specialness and options, though. Because when you think about an options market maker, we actually have a paper on this, and when you think about an options market maker writing a put option, for instance, what does that options market maker eventually have to do? The options market maker eventually has to lay off that exposure by short selling him or herself. And we have data from one options market maker, and we show exactly that. Is that when people are coming to that options market maker to get short exposure, that option market maker shorts in the spot market. So it's as if there's sort of institutional arbitrage, where a short seller would prefer to short sell in the regular stock market, potentially, but instead goes to the options market. The options market maker then goes back to the spot market to do the short sell himself. The question is, and sort of the key question that confounds everything, is it expensive to get the short exposure in the options market? And it turns out it's very expensive to get it, especially in these cases where stocks are hard to borrow. Put options become very expensive. So sort of the interaction between options and ex post announcement day returns, I would more interpret as something about which stocks have options available more than a secondary mechanism of allowing short exposure. And maybe more specifically to your point, I've got specialness and options both included in this regression. If options availability were driving sort of a loosening or a slackening in short sell constraints, then it might be the case that specialness wouldn't even show up after options, but if it does.
Yeah, I was curious that the table where you showed the percentage of returns, the drifting, right?
Yeah.
So if you partition the specials, the column which has the slower adjustment, partition that group into the ones where there are option alternatives, because specials already are an expensive form of shorting, right? Maybe you find stronger results in the subset which has specials and does not have options. It might even strengthen your.
Yeah, okay, that's a good suggestion. I like it. Thanks. Yeah. Yeah, they do suggest that. I probably have to be very careful about defining sort of the window here to say much about sort of the connection between his paper and mine. But this window is a 2-quarter window, effectively, and I'm asking how much does the announcement day return itself relate to that 2-quarter window? But to the extent that the 2-quarter window represents the sort of short-run reaction, then yeah, this is saying something. The short window returns on this is something that I don't know. In the paper, I have sort of 60 and 120 days, but it's still not going to be precise enough to get at what you're talking about.
Well, these are all great questions, but in order to stay on track, we need to go ahead and conclude right now. But thank you very much, Adam.
Thanks.